Equities are pushing deeper into record territory, powered by artificial intelligence and semiconductors, even as oil, inflation, and the Strait of Hormuz create a very different macro story beneath the surface. This is vTalkInsight, Equity Pulse Daily for May 27, 2026, where we connect those cross-currents and ask what they really mean for equity risk and leadership. Global equities, and especially U.S. benchmarks, are grinding to fresh highs, with technology and artificial intelligence still doing most of the heavy lifting. Yet the compensation for taking equity risk over bonds has almost disappeared, with the equity risk premium now back near levels last seen after the dot-com bubble. That compressed risk premium is being justified, for now, by very strong earnings data. S&P 500 earnings grew roughly 25% in the latest quarter, with consensus looking for high teens growth in each of the next 3 quarters and about 20% over the next year, while corporate margins are expanding at close to a 9% annual rate, a pace rarely seen in recent decades. Against that, the inflation and policy backdrop is shifting in a less friendly direction. Persistent energy-driven price pressures are expected to keep headline inflation near 4% this year, with risks pushing closer to 5% if shocks persist, and there is an expectation that the Federal Reserve's upcoming projections will mark core personal consumption expenditures higher, reinforcing a higher-for-longer rate stance. Markets are already discounting the Fed's forward guidance and have moved to price in the possibility of another hike by early next year, even as some forecasters still point to the first rate cut only around December. Long-end yields are being driven more by real rates and fiscal concerns than by inflation expectations. Current bond yields are seen by many as attractive relative to equities, and yield curve flattening trades are back in focus, all while equity issuance remains below historical norms and implied volatility stays low, leaving hedging relatively cheap, but lightly used. The biggest macro swing factor remains the Middle East, where strikes on Iranian assets, mining activity, and drone incidents around the Strait of Hormuz are keeping a critical energy choke point effectively constrained. The longer that disruption persists, the more economic damage accumulates, yet equity markets are still largely focused on the artificial intelligence boom rather than on the downside growth scenarios embedded in energy supply risk. Oil prices have whipsawed, with Brent dropping about 7% before rebounding more than 2% as headlines shifted between U.S. strikes and hints of renewed diplomacy. The crude curve is in steep backwardation, and the gap between physical and paper barrels has narrowed, suggesting traders see tight near-term supply but also assign some probability to either a diplomatic resolution or demand destruction bringing prices down later. In the meantime, elevated crude and refined fuel prices are reinforcing a stagflation narrative. Headline inflation is expected to hover around 4%. Consumers now anticipate price growth above that level. Gasoline above $4 a gallon threatens discretionary spending, and high jet fuel and liquefied petroleum gas prices are already causing demand destruction across parts of South and Southeast Asia. Europe is particularly exposed. Prolonged closure of the strait could tip several energy-importing countries into recession and force central banks to halt or reverse planned tightening, while reopening would offer material relief but not solve structural growth issues, especially in German manufacturing. Emerging markets face a similar dilemma, as persistently high oil close to $100 could prompt preemptive rate hikes, challenging growth even as energy exporters and selected equity sectors, including European oil names, benefit from the higher price deck. Within equities, the artificial intelligence complex is still the clear performance engine. Semiconductor stocks have driven roughly 62% of the year-to-date rally, pushing indices to new highs and leaving market leadership unusually narrow, even as broader megacap technology valuations are seen as relatively reasonable compared with the froth in the most AI-exposed chip names. Fundamentals in that space are powerful. Semiconductor sector earnings grew around 50% last quarter. About 90% of technology earnings revisions are coming from chips, and memory in particular is in a sharp upcycle, with Micron's gross margins swinging from negative to more than 80% in a few quarters and supply still struggling to meet surging demand from AI inference workloads despite planned capacity additions. Behind those numbers sits a massive capital expenditure wave. AI and data center budgets among the largest technology firms have jumped from about $550 billion to $750 billion year on year. Data center demand is expected to outstrip capacity for at least 5 years, and labor shortages in critical trades like electrical and mechanical work are becoming bottlenecks. All of which is driving substantial bond issuance by hyperscalers and rapid growth in credit default swap markets tied to that debt. The AI story is also reshaping regional leadership. Taiwan's equity market capitalization has overtaken India's, propelled by Taiwan's semiconductor manufacturing company and the broader AI boom, while Asian indices led by South Korea's Kospi and Chinese chipmakers are rallying on optimism about domestic technological advances at Huawei and others that could reduce reliance on foreign suppliers. At the same time, not every AI-linked asset is being rewarded. Software valuations have compressed sharply, with public market multiples moving from the high 20s to the low teens and private deals priced in high single digits. Private equity is heavily exposed to the sector, and some newly rebranded AI infrastructure names, such as Wolfspeed, have seen spectacular share price spikes alongside rising short interest and expensive borrow, reflecting meaningful skepticism even as securities lending revenues rise on AI-related shorts. The United States remains the relative winner in this mix. U.S. equities are outperforming global peers, helped by lower direct dependence on oil, strong innovation and productivity gains tied to AI, and a resilient upper-income consumer segment that is keeping retail sales solid despite record low confidence readings and mounting concerns about inflation. Europe tells a more complicated story. Equity and foreign exchange volatility there has fallen back toward pre-war levels, yet indices still lag the U.S. and parts of Asia due to energy dependence and growth worries, even though there is significant catch-up potential if the Strait of Hormuz reopens and if sectors leveraged to defense spending, infrastructure, and basic resources, including companies such as Rio Tinto, Glencore, and retailers like Kingfisher, continue to show operational resilience. Emerging markets sit between these poles. They are favored in some views because of expected productivity gains from technological adoption and the possibility of a softer U.S. dollar, and they are already seeing more than $10 billion of inflows into local currency funds, while the AI-driven investment cycle is fueling strong domestic equity flows in Korea and Taiwan and supporting certain commodity exporters, even as high oil prices threaten to force preemptive tightening in more fragile economies. Sector rotation within regions is equally stark. European auto manufacturers face sustained pressure from Chinese electric vehicle competition, with Chinese brands now accounting for up to 15% of regional sales. Chinese consumer internet stocks are under strain from renewed regulatory crackdowns on cross-border trading, yet defense and aerospace names stand to benefit from rising NATO and U.S. defense budgets. And commercial real estate shows a clear split as prime offices in New York, Miami, and Beverly Hills command record rents while lower quality assets struggle. On the stock-specific side, several names crystallize these broader themes. Micron has become a poster child for the AI memory story, with its shares surging after a dramatically higher price target from UBS and large U.S. investment commitments backed by political support, while Samsung's chip division now generates the majority of that company's profits, underscoring both the sector's earnings power and the supply chain risk for U.S. firms that depend heavily on its components. In megacap technology, Apple has just logged 9 consecutive positive weeks, its longest winning streak since 2017, as momentum-driven investors position for a potential major AI announcement at its upcoming developer conference. Bank of America has raised its price target, highlighting Apple's control over app access, authentication, and payments, even as it flags execution risk around AI integration, and Dell is rallying ahead of earnings on optimism that strong AI infrastructure demand and positive read-through from Lenovo will translate into upgraded guidance. Energy and autos are sending a different set of signals. BP's shares fell nearly 4% after the board abruptly removed its share over governance and conduct concerns, raising questions about strategic direction, just as oil majors face renewed scrutiny around Middle East risk, while Ferrari dropped around 8% following the debut of its first fully electric car, a larger decline than usual after model launches, as long-standing customers and analysts voiced unease over the design and the brand's positioning in an increasingly crowded electric vehicle market. Consumer-linked names continue to illustrate dispersion and sensitivity to expectations. AutoZone slid about 9% after missing revenue forecasts and showing sluggish international growth, highlighting how quickly premium valuations can compress when margins are questioned, whereas Kingfisher rallied more than 5% after simply reaffirming full-year guidance, suggesting that in parts of discretionary retail, delivering resilience in the face of higher fuel and living costs is being rewarded even as sector valuations sit at historically low levels relative to the broader index. Finally, defense, space, and healthcare offer important long-horizon signals. Boeing's defense arm has now reported 5 consecutive quarters without new charges, is ramping F-15EX fighter jet production with slots sold out through 2036, and stands to benefit from a projected double-digit increase in the U.S.-based defense budget plus an additional $100 billion supplemental that prioritizes missiles, space, and counter-drone capabilities, supporting companies such as Kratos, AeroVironment, and CACI. At the same time, enthusiasm around the upcoming SpaceX initial public offering is lifting space-related stocks like Rocket Lab, and Eli Lilly is using cash flows from its obesity and diabetes franchise to acquire 3 vaccine developers for about $4 billion, marking a deliberate diversification back into vaccines and gene therapy to reduce reliance on a single blockbuster category. Putting this together, global equities are trading as if the artificial intelligence productivity story and robust earnings can more than offset a world of higher-for-longer rates, compressed equity risk premia, and persistent geopolitical friction around the Strait of Hormuz. The main tensions are clear. Oil and supply shocks are feeding sticky inflation and stagflation risk, while bonds are starting to look more competitive against equities, just as index leadership narrows further into semiconductors and a handful of mega-cap names. At the same time, capital continues to flow into AI infrastructure, selected emerging markets, defense, and prime real assets, and company-level moves at firms like Micron, Apple, BP, Ferrari, Boeing, and Eli Lilly show how strategy, governance, and capex choices are being rewarded or punished in real time. From here, the critical signals to watch are upcoming U.S. inflation data, especially personal consumption expenditures, evolving Federal Reserve communication, any concrete progress or setbacks in U.S., Iran negotiations around reopening the strait, the next leg of AI-related earnings from hardware and software names, and how consumers and retailers hold up under higher energy costs. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.